really is a pleasure to be here in person, especially in glorious Cape Town. Thank you all for joining us today. Uncertainty is, of course, all around us at all times, but I can't think of a more important time to be discussing how to navigate it within client portfolios than now. The global financial crisis and the pandemic stand out as the most recent really extreme periods of uncertainty within markets. But I'd argue that the conditions today, the position we find ourselves in today, is as acute, if not more so, than those, with a very, very wide range of potential outcomes over the longer term. No surprises as to the main drivers behind that: the conflict in Ukraine, geopolitics more generally, and also inflation as well. The conflict in Ukraine has become a proxy war between NATO and a nuclear superpower in Russia, which really marks it out from other conflicts that we've seen in the past few decades. And as well as the awful toll that it's taken on the people of Ukraine, the immediate consequences, of course, for markets and the world have been in the form of a supply shock in natural resources and key commodities. And in that respect, Russia supplies some one-eighth or so of the world's oil and about a sixth of the world's natural gas, and combined with Ukraine, some 30% of the world's wheat. So no surprises that we've seen such sharp rises in commodity prices. The most extreme has been European natural gas, up some 6 times in the past year or so. But beyond that, I think the longer-lasting consequences are going to come from how the world reacts to these events, and they'll last longer as a result. So particularly in terms of energy security, we're seeing more investment into renewables and a rethink of the use of fossil fuels for longer than had previously been thought before. You've got this conflict between the need for some energy security going against the drive for reducing the carbon footprint of the world, and then also rethinking the use of nuclear as well. And then defense policy as well. We're likely to see much more military spending. We've already seen a big pickup, including a complete about turn from the likes of Germany, who've suddenly caught up with NATO's military spending targets. The likes of Finland, Sweden now looking to join NATO all of a sudden, having been neutral for so long. So long-lasting, deep-seated shifts there. And then, of course, an acceleration of the retreat from globalization, which I suppose really started with the pandemic and the response to that. But the world's benefited from globalization for several decades, but that's now going into reverse. There's no end in sight for the conflict, and the longer it goes on, the greater the risk of deep, long-lasting global economic consequences, and of course, the risk of escalation as well. And then there's China. With regards to Russia, to begin with, President Xi has talked up his special relationship with Putin. Got a question: how sustainable is that going to be when Russia is now essentially a pariah state, unlikely to be welcomed back onto the world stage for a long time? And only 3% or so of China's foreign trade is with Russia, compared to 30% with the US and Europe, which you would think would focus Xi's mind, given that could be at risk. And then the question of Taiwan as well. The Western response to Russia's action probably delays any chance of action by China in terms of seizing Taiwan, but that risk does continue to linger. And then China's really battling on its own home turf as well. You've got the zero COVID policy, of course, which is battering growth and further dislocating supply chains, and of course a property debt bubble that is really hammering the whole economy at this point. So lots of uncertainty there. And then finally onto inflation. I think this is the biggest concern out there at the moment. The post-pandemic surge, which was of course driven by the release of pent-up demand and also supply chain disruptions, risks becoming more persistent and more entrenched the longer these conditions persist. Consumer price inflation is above 7% in many major economies around the world, at multi-decade highs. Producer price inflation is in double digits in many countries as well. Over 30% increase in producer prices in Europe in the past year. And then this is starting to feed through into a spike in wages as well. It's starting to feed through more there. And that's something that's stickier and more troublesome for markets. wages don't revert down in the same way as commodity prices often do. So the genie of inflation is very much out of the bottle and could prove difficult to get back in. Going through later into the year, we're likely to see more impact from this on consumer spending and business margins as well. Central banks have, of course, been behind the curve and are now racing to catch up. And although there's a lot of tightening ahead, priced in already, rates are still very low in a historical context, and real rates are still deeply negative, adjusted for spot rates of inflation. So there is the risk that markets and policymakers are still underestimating the need for further tightening ahead, which could have grave consequences for markets, and of course increases the risk of a hard landing from this point. So all very gloomy, but ultimately it's a very difficult environment, and as I said, a very wide range of outcomes from here. And it's a very different environment from what most people have experienced over the course of their careers and what we've seen over the last few decades or so. So no surprises that we've seen such volatility in markets in recent months. This is a proprietary market turbulence index that we create, which estimates risk aversion within markets based on a variety of different indicators. And you can see there was a big spike, as you'd expect, around the time that Russia invaded Ukraine earlier in the year. And it's picked up a bit more since then, since we last updated it, but still well below the levels that risk aversion reached during the height of the pandemic, when you had much more systemic risk back then. Recall that there was a week or so in March when Treasuries' liquidity pretty much dried up. We haven't seen that this time round, but we have seen a pickup in volatility. I'd argue it's been quite measured and reasonable, actually, given the circumstances. And I'd also argue that it's probably likely to stay pretty elevated throughout the rest of this year and potentially beyond. But the question I'd like to ask at this point is, what should investors and their advisors do about this? My answer would be prepared. Rather than trying to predict the future and not expecting surprises, be prepared for surprises. I think this quote sums it up quite well. As human beings, we're not wired for randomness. We can't process the millions and millions of different scenarios that can come to pass. We try and bucket it into a few different scenarios, reflation, stagflation, whatever it may be. But the reality is surprises happen, and much more often than we like to expect, actually. And it's these unknown unknowns, such as the examples shown here, that actually do the most damage to portfolios and cause those sudden shocks in markets. But an interesting thing to think about is, even if we had perfect foresight and saw all of these things coming, would we be able to profit from it in portfolios? Would we have expected that in the year when Trump got elected, or in the few months thereafter, that the US market would go up some 20%? Certainly wasn't what people would have expected prior to his election. Or indeed, in the pandemic year, when the world economy literally shut down, the global equities would return 16%. I think not. But what I'd like to do is extend that thinking to market pricing. Theory goes that all information is instantly assimilated into market prices. But the reality is, we can't predict the future. It's very uncertain. And that gets reflected in what is discounted by markets as well. What we see here is the forward market expectations for Fed funds in the US, shown by the grey lines there, at various points over the last couple of decades. So the grey lines are what the market's pricing at that point from where it starts, and the red line is what actually came to pass. And so what this clearly shows is that the market has been pretty much completely wrong over all of this period, particularly that kind of 2010 to 2020 or so decade, when it was predicting a lift-off in rates, quite a material one actually, which never actually came to pass. And this is in an instrument which is arguably one of the more easier ones to forecast, especially in this era of very heightened central bank guidance. So then what are the chances that today actually the market is severely underestimating the need for further tightening ahead? But what I'd say that we should do actually is focus on what we can control and actually remind ourselves of the rewards that come from uncertainty. Here we see the US market return over the very long term back to 1900, so 120 plus years. It's shown on a log scale because otherwise the compounding distorts the graph too much. So what you're left with is the line showing the average rate of growth over that period. This is in real terms as well, so already adjusted for inflation. It just shows you how incredibly lucrative investing in US equities has been and how very well compensated investors have been for sticking with that for the long term. Spot the crises there, Black Monday, the oil shock of the 70s, the pandemic, the financial crisis. Yes, you can just about see them, but they're tiny blips and the market recovers pretty quickly from there. So with that sort of information, simple as it may be, and as I'm sure you've heard similar many times before, but surely the burden of proof on why not to stay invested in that must be massive. But the biggest challenge that we face ourselves and you face daily is maintaining a long-term focus and fighting those behavioral biases that Jeanette referred to. But if we can, then the wild swings in markets, in greed and fear, can be used to our and our clients' advantage. I'll just touch on a couple of examples quickly of how we've done that in our portfolios at MGIM in the UK. Here's one from the pandemic, where the red line here is US nominal bonds, the blue line is inflation-protected bonds, or TIPS. In the space of a few weeks in March 2020, inflation-linked bonds underperformed nominal bonds by 10%, a massive figure for fixed income investors. And at that point, TIPS were implying that US inflation over the following 10 years would be just 0.6% per annum, far, far, far below long-term history averages. We thought that was far too pessimistic. The pandemic would clearly end at some point, and especially once you saw all the massive, massive fiscal and monetary stimulus being thrown at the problem, we felt it was likely that inflation would actually be quite a bit higher. That, of course, is what has come to pass. But in the course of 2020, after we shifted a lot of our government bond exposure from nominals into TIPS, those TIPS performed very well, outperforming nominals substantially, and that's actually continued beyond the end of this graph in 21 and 22 as well. But then, moving on to another example, the global universe is huge. It's broad, it's deep, it's vast. There's so many different asset classes, sub-asset classes, and different investments to take advantage of. And this is one example of a fairly niche asset class, but one that we think works super well in multi-asset portfolios over the long term. And we've had a strategic allocation to it for many years. Convertible bonds, they're effectively corporate bonds with an equity option attached to them. And the really nice thing about them is over the long term, they've given you something close to equity market returns, but with much, much lower volatility along the way. Again, during the pandemic, they sold off very significantly, more or less falling in line with equities and high-yield bonds as well, and no value being ascribed to that equity option to the upside that I talked about. So we increased our allocations there. We already had some, but increased it materially. And you see, there was a huge recovery there, and actually, it was up 70% from the lows to the end of the year, and ended the year as the best-performing asset class globally in risk-adjusted terms. So a specific example that we took advantage of, but making the point that it's a huge universe, and there's loads of scope to add value through tactical asset allocation opportunities. And then, going a step further, within asset classes as well, using the best specialist managers, whether it's value or growth or equity or credit, large cap or small cap, the best managers active within their asset classes can add significant value in terms of risk-return benefits and taking advantage of that uncertainty within asset classes. This is a subset of the managers that we use within our portfolios. You probably recognize some names, but some you wouldn't hear. I mean, they're often boutiques or more focused businesses specializing in a particular area. We've spent years, decades collectively focusing on manager research. There's no magic formula to finding the best manager in a particular area. It's usually made up of lots of finer differences around firm ownership, philosophy and process, team longevity, assets under management, general alignment, and many other things as well. But they all add up to create that recipe for a great active manager and long-term outperformance. And contrast that with the very biggest shops out there, the one-stop shops who can give you pretty much every strategy under the sun. But what are the chances that, like our best-of-breed approach, that they can be really best in class across all of those areas? I'd say very little to none, actually. And so bigger is not necessarily better, and using specialists like this really help us to take advantage of the uncertainty within markets. And then Strategic asset allocation is another key aspect of how we construct portfolios. It's really the outset, the starting portfolio that we build from. Here we make the most of the breadth of the global universe and use a wide range of different asset classes to build that strategic asset allocation. So not just equities and bonds, but think property, infrastructure, alternatives, commodities, inflation-linked bonds, emerging market equity, whatever it may be. Put all of them into the mix. And here's an example of where we're really harnessing technology to help us address those blind spots that we have and our inability to process the millions and millions of different scenarios that are possible going forward. So we use historical risk relationship data rather than returns to create an optimal mix of those asset classes that gives you the best chance of delivering on the outcome that we're targeting for clients, but with the lowest risk along the way. And essentially the most robust solution that can withstand a wide range of different market environments. So millions of scenarios there, and ultimately come up with what should be a better risk-reward outcome. Great in theory. How have we done in practice? This is our global managed solutions range, showing net of fees since inception, which is 14 years ago. They're the red dots there, relative to the blue dots are the rest of the South African multi-asset fund universe. So we've delivered better risk-adjusted returns than almost all of the peers there across those different risk profiles. Volatility is not a perfect measure of risk, but it is incredibly important because ultimately drawdowns and that uncomfortable volatility can, and so often does, cause clients to divest at the wrong time. So we've done a good job of reducing that there for all of those different levels of return and helping clients to stay invested. And this speaks to the point Jeanette was making about, I suppose, that switch itch side of things, where clients go through tough times and they change, and it ultimately detracts value from the long-term outcomes. Here, we're trying to manage that. We're trying to smooth the journey and ultimately trying to help clients to improve their behavior. These funds, incidentally, are available in dollar terms on the Momentum Wealth International platform and also locally through RAND feeders. And then this is a schematic of one of those portfolios. So the inner ring there is the strategic asset allocation, the high-level asset allocation shown represented by those, the legend there. But then there's many other layers of diversification within there. The middle, you've got sub-asset classes, different sectors, different geographies, etc. And then on the outside, you've got the specific strategies that we use there through different styles and much more focused, concentrated portfolios or strategies in many cases. So the overall combination is designed to be safe and robust and to provide a smooth journey, but the individual ingredients can be much more volatile themselves. There's three things I'd highlight here that are quite different from a lot of the other portfolios that you might look at. One is within the equity side of things, we've always believed in blending the more extremes of styles, so not just value and growth, but deep value with quality and momentum-oriented strategies. That's where you find the highest conviction managers and ultimately, over the long term, the best risk-adjusted returns. We've maintained those value allocations for a long time, and it's been out of favor for some time. But last quarter, we saw a massive snapback, the biggest quarter of outperformance for value versus growth on some measures ever. So we really benefited from that exposure within portfolios. Our best performing value manager globally returned over 20% for the quarter in a market that was down some 6% or so in dollar terms. So that was outperformance of over 40% relative to the US FANG index, so the big mega cap tech stocks that many people have been piling into, and over 60% relative to Cathie Wood's ARK Innovation ETF, which again you may have come across before. So massive outperformance. So that concentration and maintaining that diversification within styles was incredibly valuable, and a lot of other portfolios don't have enough exposure there. And then real assets as well, another area that we've liked for a long time, so property and infrastructure and the like. Good yields, good stability, which is valuable, especially when government bonds can't be relied upon for that so much as they were in previous decades. But also a high degree of inflation linkage within the revenues as well, which has really benefited them in this recent environment and has been a great source of stability over the course of this year and longer, actually. Again, very specific investments, data centers through to wind farms and beyond and the like, but managed by specialists, experts in those areas. And then one other would be private assets as well, which we can get access to through the London-listed closed-end fund universe, which helps, it removes the illiquidity mismatch that can come with private markets investing. So it enables us to buy it within a liquid solution, no lockups or anything or liquidity mismatch in sight. Private equity is incredibly important, in particular, because companies are staying private for longer and longer these days. A good example is Amazon. They listed back in 1997 with a market value of less than $500 million at the time, and that was only 3 years after they were incorporated. So that left loads of lucrative growth potential on the table for public markets investors over the subsequent decades. But today's equivalents, a couple of examples within our portfolios on a look-through basis, Klarna and Revolut, they're already valued in the tens of billions of dollars, and they've got no plans to list anytime soon. So if you don't have a means of accessing private markets as well, equity, debt, and beyond, then you're missing out on potential growth and diversification opportunities. So the point here is no shortage of conviction within the portfolios, but very carefully curated to create an optimal mix for the long term. So what I've talked about is no doubt fairly intuitive, but the point is, the reality is it's not easy to implement on a consistent basis. At MGIM, I think we have the resources, the experience, and the focus to do a very, very good job of this, as we have done since we were set up in 1998. A few things I'll just emphasize on this slide. I think of us as being one of those best-of-breed specialists. We're focused. We specialize in multi-asset manager research and portfolio construction, and aim to just do as good a job as we can in that, rather than trying to be all things to all people. So we've got that on our side. We're well-resourced as well. We've got an investment team of 21 people with a lot of experience. But also, beyond that, you think about our underlying portfolios. We've got hundreds of the very best investors from around the world working on behalf of our clients. And then finally as well, performance is paramount, and it's mine and our team's primary focus, but we recognize the importance of partnering with clients properly as well, being there to enable your business and help you during the tough times, seamless operations, etc. All the other things that are incredibly important in the client value proposition. So it's a personal approach which has really helped us over the long term and has helped us to ultimately maintain and grow our assets to £5 billion now. So that's us, and that's how we think about harnessing uncertainty ultimately for the benefit of clients over the long term. The bottom line is to expect and be prepared for surprises. Get comfortable with being uncomfortable and stick with it for the long term and try and help clients to do the same. And I think that's more important than ever today, particularly deep, effective diversification within portfolios to help protect on the downside and to be ready to take advantage of opportunities and dislocations that can and inevitably will come along. I genuinely think that the next 10 years in markets could be just wholly different from what we've seen over the last 10 years or so, and most portfolios are not prepared for that. They don't have enough exposure to the out-of-favor parts of markets, value, for example, or they've got too much exposure to bonds, which still have a place, but it's much more nuanced. And one other thought I'd leave you with is just that whoever you use for global exposure, make sure that they're using the full breadth of the global universe, in terms of asset classes, as I've talked about already, but also just focusing within equities, for example. So many of the most popular funds out there, they might have 40, 50 stocks or something like that. The global universe is some 9,000 securities across the cap scale. So if you're only less than 100, it's less than 1% of the universe. And I don't see how you can justify really doing that, given the range of growth opportunities out there and mispricing as well. And as Michael comes on to talk about later, a lot of the most disruptive, innovative businesses think differently, and they don't necessarily have that big legacy of an established business behind them. So you could miss out on many of those sort of opportunities. So just to wrap up, and coming back to what I mentioned at the outset, I'd reiterate that there's a huge amount of uncertainty at this point and a very, very wide range of potential outcomes. However, that cuts both ways. At this point, markets are already discounting a lot of the risks ahead. Fed funds are up to 3% or so, or predicted to reach 3% at the end of the year, which is already ahead of the Federal Reserve's own forecasts, and similar across many other countries. Bond yields are approaching their highest level in a decade or so. And the global economy, although buffeted, is actually in very good shape in terms of employment and demand and growth opportunities ahead as well. And I think as we move into the second half of the year, we're likely to see a lot more of that central bank tightening coming through. Inflation could start peaking. It'll remain above average, but could start coming down. And perhaps some of the biggest risks from the war will be diminished as well. Equity markets have corrected massively already. Focusing on kind of the epicenter of some of the issues at the moment, US growth stocks are down 40% from their peak. Last year, that was. Chinese stocks in the last little bit over a year, down 50%. Russian stocks have been completely wiped out and ridden off. So there's a lot of bad news in the price already. So don't be surprised if actually things end up being a little bit better than expected. Like Jeanette, I'll end on a quote, this one by Niels Bohr, a physicist, who said that prediction is very difficult, especially when it's about the future. I'd argue that today what's called for is discipline and patience, and ultimately staying invested and keeping clients invested. Thank you very much.